I'm about to go through a Social Security taxation case study to show you how much one of my subscribers will pay in Social Security taxes based on their income. Hi, my name is Jacob Duke, and as the owner of a retirement planning firm, I know how important it is to understand the different sources of income that you will have in retirement and how they'll be taxed. And Social Security is a big part of that. Some people think they're going to pay tax on all of their benefits, and others think they're not going to pay tax on anything at all. So let's go through this example together to understand this better. Now, there's two important things that you should know before we go ahead and get started. The first thing is that you will not pay any tax on any of your Social Security income in retirement if that's your only source of income. So if Social Security is your only form of income, you don't have IRA distributions or earned income or a pension or anything else that's coming in, you're not going to pay tax on any of your Social Security. And the reason for that is because how Social Security taxes are calculated, which again, I'll show you in just a moment. The second thing to know is that no more than 85% of your Social Security benefits would ever be taxed. So not all of your benefits are subject to taxation. Only at most 85% are subject to taxation, but it could be less than that. Again, we'll show you why here in just a moment. Now, with those two things out of the way, again, there's 3 steps here to make sure that we calculate this correctly. The first step is we have to find what's called a provisional income or a combined income. And you can see here on the screen, the IRS or the Social Security Administration website has this called the combined income, and you can see the formula there. The first thing we've got to do is take half of our Social Security amount, whatever that is. We take 50% of that. We add in our other earned income or our IRA distributions or our pensions or any other taxable income that's coming in. We've got to take that amount, add that back to 50% of our Social Security. And the final step is to add any non-taxable interest to that. So that can be interest from a municipal bond or something along those lines. And you wouldn't normally pay income tax on this, and you're not paying income tax on it, but that interest, that non-taxable interest, has to be added back into your provisional or your combined income in order to make sure we calculate this correctly. So that's the first step. We've got to find a provisional income to see what we're working with here. The second step is to run that provisional amount through the provisional income tax brackets, and you can see those here on screen. We're going to be looking in this particular situation at the married filing jointly. So you can see there that the first bracket is from 0 to 32,000, and any money that falls into that amount, the first 32,000, none of that amount is subject to taxation when it comes to Social Security taxes. Anything from 32 to 44, that's the second bracket there. Any of that $12,000 that falls in that bracket, 50% of that amount is subject to taxation. And then anything above 44, 85% of that amount is subject to taxation. So again, I'll help this make more sense here in just a moment as we go through an example, because that might not make any sense so far. Then finally, the third thing that we've got to do is we got to take what our Social Security taxable amount is and add that back to our other income, our IRA distributions, our pension amount, our working income, whatever it might be. Add that back in so we can calculate our true taxable income amount as we run it through the normal income tax bracket. So if you have to stop and rewatch that, go ahead and do that. I totally understand, but maybe the example we're about to go through will be helpful to make this make more sense. Okay, this example comes in from a comment on my last Social Security calculation video from CG in London, and it says, could you do the same video with a married couple taking $40,000 a year from an IRA and then $60,000 a year of combined Social Security? Running my own calculations, it says it'd be a $70,000 provisional income, $6,000 at 50%, and then $33,300 at 85% taxable. So pulling $38,300 into the Social Security income tax calculation. Is that accurate? Part of it's accurate. Based on the first looks, it does not look like all of it is accurate. Something gets off there in step 2 whenever we're kind of figuring out how much of the Social Security amount's taxable. So let's go ahead and look at that. So here's the example. I got this kind of written down a little bit. So right now we've got $60,000 in Social Security income, and then he mentioned $40,000 of IRA withdrawals. So that's kind of our total income number. That equals $100,000 total per year. So that's a fairly healthy income. And so what we're going to see in just a moment is that very little of that amount of income is actually subject to taxation because of how Social Security is taxed. So let's kind of dive into this a little bit. If we remember, the first step of the process here is we got to find the combined or provisional income. We got to figure that out first. If we think back to that, the first thing we've got to do is take half of our Social Security amount. So in this situation, $60,000 is the Social Security amount. We take half of that, and then the full amount of his IRA distribution, since that's his only other source of income. What that does is the combined income or provisional income equals $70,000. Okay, so he's got that right part. He mentioned that in the comment. I think it's gonna be $70,000. He's got that so far. That's accurate. Now, the second step is to figure out of that 70, using that combined or that provisional income, we have to now run it through these brackets, as mentioned, and that'll tell us how much of his Social Security income of $60,000 actually is subject to taxation. So the first $32,000, none of that is taxable. So we've got that under control. The next $12,000, the range from 32 to 44, 50% of that amount is taxable, okay? And then anything from 44 and above, 85% of that money there is taxable. So if we do the math on that, if we say, nothing is taxable from 0 to 32,000, and then from 32 to 44, that amount will be 12,000 if that's filled up all the way, which in this case it is, because 70,000, remember, is our provisional income. So that's more than 44. So 12,000, and then half of that amount is subject to taxation in terms of Social Security. So $6,000 comes from the second bracket, and then anything above that, 44 and above, which would be 26,000. So if we take 70,000 and subtract out 44, that would mean anything above 44 is left over, which is the amount of $26,000. We take that amount, and then 85% of that 26,000 is subject to taxation, which you can see is 22,100. So the total amount of Social Security that is subject to taxation, he's getting 60, or they're getting 60 combined. The total amount that's actually taxable to them is only 28,100. You just simply take the 6,000, you add in the 21,100, and now you have 28,100. So that is the total taxable amount of their Social Security that they have to factor into their income taxes. So that brings us to step number 3. And if you have questions about this along the way, put them down in the comments, because I know this is not going to be easily understood first time around. Put them in the comments. Happy to answer those for you. And if you're liking this video, you can just let me know in the comments as well. I want to make more of these if they're helpful, maybe some different scenarios. Give me some ideas. I'd love your help on that. Okay, so the third thing we've got to do now is we've got to just run through our normal income tax brackets. So we have to use this taxable Social Security amount, add in our other sources of income, and then we can run this through the normal brackets. Okay, so what we've got here is we have an AGI now of $68,000. So $40,000 is the IRA distribution. This is the taxable Social Security income amount. We add that together, it gives us 68. The standard deduction, I'm just using the standard for them. They're married, filing jointly in 2025. That is $30,000. And if you're over 65, you get a little extra bonus on there. So I'm just going to assume that they're not. So $30,000. So if we subtract out that minus this, we get a taxable income amount of $38,100. So that's their taxable income on $100,000 of gross income. Okay, so we run that through the tax brackets. The first $23,850. Again, I'll throw those up here on the screen just for you to see. And if you'd like a copy of this little, thing I'm walking through, this PDF here with all these important numbers, just shoot me an email. My email should be listed down below. Shoot me an email directly. Ask for that important numbers, PDF or document. I'll send that over to you. It's free. Take it, use it however you'd like to your benefit. So if you want that, just shoot me an email. But the first bracket in 2023 at 10%, married, filing jointly, is up to $23,850. So at 10%, that equals $2,385 of taxes on that bracket. And then they have $14,250 left over. And that would be the 12% bracket, and that's their taxable amount there. So what does that put us at? Well, their total tax to be paid is $4,095. Okay, so that's their total tax to be paid. But remember, they make $100,000 between their Social Security and their IRA distribution. So they're making $100,000 gross, and they're only paying taxes of that amount, which means that's a 4% effective tax rate, and that's a really low tax rate, right? $4,000 on $100,000. That's really hard to come by, and anybody would take that any day of the week. And that's all because of how Social Security taxation works. Remember, we just walked through this formula, but the key is that provisional income, which then funnels through the provisional income brackets. The amount of taxable Social Security is so much lower than what they're actually getting. That's the key in this whole thing, and that's the benefit of having Social Security as one of your sources of income in retirement. So what I want to do really quickly maybe is just check this out and see, hey, what if they didn't take so much out of their IRA? Is there a way to have like income from their IRA but not pay tax on any of the income or Social Security? I want to see that really quickly. So what I wanted to do is, let's say we keep the $60,000. Let's keep that the same. But what if we bump this down to $20,000? Okay, so let's figure this out again. So the combined income is going to be 30,000 again, but instead of here, we're at 20,000, okay? I might have to do a little calculator math for us here as we go. Bear with me if it slows down just a touch, but I think this will be fun. So instead of $70,000, now we have $50,000 is the combined income, okay? So $50,000. Now we run that through the brackets. So the first 32 again is 0% of that 32,000. The first amount there is subject to taxation, which leaves, is that 18,000 left over? So 18,000 is left over, right? So 18K is left over. The next 12,000, again, 32 to 44, that amount is 50% taxable. So again, 6,000, that's the correct amount there. But now only, instead of 26, we've got 6,000 left over, and this is not going to be right. So 6,000 times 0.85 equals $5,100. So that's the amount above 44,000 that's left over. 6,000 bucks of that 85% is subject to taxation. So now we have a total of $11,100 between these two, right? That's our new total taxable Social Security income amount. So we had $60,000 of Social Security, but only $11,100 is taxable. And that's in comparison to previously, remember we had $22,100, and that's because we lowered how much their distributions from their IRA were. So we lowered that down, cut that in half from 40 to 20, and now that's their new taxable Social Security amount. So if we take that amount, $11,100, and we add in their IRA distribution right here, of 20,000, okay? Starting to see something really interesting. Now their total AGI, okay, is what is that? 31.1? That's their new AGI. But what's interesting here, if we look at the standard deduction of $30,000 here in 2025, we now have a $30,000 standard deduction. We have $1,100 left over. Again, if they are above 65, that amount there would be erased, right? It'd be X'd out. We wouldn't have it because there'd be additional standard deduction added on top of the 30. If they're under 65, then, it'd be the standard 30,000. But that amount at 10%, what does that come out to? $110? Pay $110 on $80,000. So again, your tax rate's minimal, if any. Like you pay $110 on $80,000, all because of how Social Security taxes work. So if they wanted to pay no tax on $80,000, that's how they could do it. $60,000 from Social Security, $20,000 from an IRA. And what you can do here, and you can kind of start to see, is that whenever you're putting your income calculations together, you're trying to decide where to pull income from and when to pull it and all those good things, you can start to piece it together in this way, do some math on the back end yourself and say, hey, if I have 60,000 of Social Security and I only take 20 from my IRA, that means none of this is essentially taxable. Again, you're only paying $110 of taxation on this. So essentially no tax on $80,000. Now, I'd love to hear in the comments, was this helpful? Share your information. Maybe you want me to do a case study kind of using your numbers. Hey, I got a pension of this amount. I've got an IRA distribution of this amount. I got Social Security of this amount, or whatever it might be, or maybe capital gains of this amount. Let me know in the comments. Maybe I can do more of these if they're helpful. And if you want to see more of these Social Security taxation examples or videos, you can watch this video right here.